Invoice discounting or factoring or receivable financing. These are all business financing options that have always existed for a long time. Only that in recent times, they've also turned to be a kind of an investment option for retail investors. Now, are these good for investors? What are the pitfalls of these options? What are the advantages of these options? That's what we're going to explore in this video. But first up, let's understand what is invoice discounting or receivable financing as it's called. Many small and medium businesses have very frugal capital with them. They use a limited amount of capital to purchase raw materials, produce finished goods, and then supply to another industry. And that industry, based on the terms of trade, will pay them back as per the credit period in 30 days or 60 days or 90 days as the case may be. If it's 90 days, then this manufacturer will receive back the money at the end of 90th day. That's a long period of time. Now, if I'm cash strapped, then I have to wait for 90 days to reproduce my goods. I again take the money, pay it to my vendor, collect money and process it. Or if I'm running a business that's running very fast, there's a lot of demand, I can't wait for the money to come back to produce again. I have customers waiting for me. Is there a better option available? Absolutely. As long as my products are going to reasonably large industry, well-known names, blue chip companies, there are lots of financing options available. What do I mean by that? Let us say I have supplied to a very large industry, a very reputed industry, materials worth 15 lakhs. As per the terms, I'm expected to get paid that 15 lakhs at the end of 90-day credit period. That's what the terms of agreement with that company is. Now, I may choose to wait for 90 days and receive this 15 lakhs, or I can go to a factoring company or a factoring agent who would then give me instantly a certain amount of cash flow. I don't need to wait for 90 days. I'll get it on day one. The moment I've supplied the material and I've got my bill endorsed, I can go and submit this to this company, endorse it in favor of this factoring company, in which case I will receive a cash flow immediately. Now that cash flow will of course charge me an interest for the 90 days. The amount that I will receive will be much lesser, but I receive it instantaneously. Therefore, I can take this money and plow it back into my operation and continue to produce. This way, I can do unlimited cycles of my production without worrying about capital. So in that sense, factoring is a great boon, especially for small and medium enterprises. So the typical example of this would be, let us say I supply the same example of 15 lakhs worth of material with the terms of 90-day credit period to a very reputed organization. Reputed organization, I mean a very high credit worthiness, which the market is aware of. Now I know I can wait for 90 days and collect the money from the company directly, or I can then discount it with a factoring company or a finance company and receive capital. And let's say that the rate of interest that company chooses to charge on this is 14%. Then I will instantaneously receive on day one 14.5 lakhs. I will of course lose 50,000 rupees. That's the financing cost for this transaction. I can either choose to get this 14.5 lakhs and continue my production without a bother. Now it's the finance company's problem of collecting this 15 lakhs back from the reputed company at the end of 90 days. This is how a factoring arrangement works. Now, what are the advantages? What are the disadvantages? Clearly, the advantage in this is that I get capital immediately. So I don't have to wait. I can run my production cycles pretty quickly. I can continue my production without waiting for capital. I can do with very low capital, so to say. The second advantage is collection, which is often a very difficult task for very small companies. becomes taken care of because the other company takes care of the collection. The financing company takes care of collecting the money. So to that extent, I don't have to waste time. I can continue my job of just producing and supplying. Collection is somebody else's headache. Now, what are the pitfalls? The pitfalls is I could end up spending a significant amount of money towards the financing cost, which I could have otherwise avoided. As I said in the example, out of a 15 lakh invoice, I could end up losing 50,000 rupees upfront. Now that could be the margin on my product. I could easily end up giving away my profit in that product by this. Second, sometimes some companies don't encourage this relationship. So when it comes to collection, if somebody else goes, the company doesn't consider the supplier to be a great guy. Relationships sometimes can get messed up when somebody else goes to collect the invoice rather than the supplier of the goods. So there are issues on that front as well. Now, from a financing company point of view, how does this work? It works in terms of giving a secured lending option, relatively secure. Let me not say secure, relatively secure. Why? Because the supply is going to a reasonably reputed company, the risk is very limited. To that extent, I'm willing to finance it and take the money at the end of 90 days. And given that the period is not very long, it's not a couple of years, it's just 90 days, it's unlikely that the risk will turn bad so quickly. So if you thought somebody was reputed 90 days back, it's unlikely he will become a bad debt in 90 days time. So to that extent, it's a very short period of time and it also works well for the financing company. How does this work as an investment? Now there are lots of small financing apps that have recently made their debut. What these apps do is they connect the retail investor as the financing point to the small and medium enterprise supplier. So let's say there is a supplier who's got a 15 lakh bill to be discounted. On the other hand, there could be about 100 such small investors on the other side who are willing to put in very small amounts of money. It's not the large amount, maybe even 15,000 rupees per head. Cumulatively, these 100 people would come and be part of the financing this option. So really these apps, what they're doing is connecting the two ends of the spectrum using technology as a tool. So they get 100 people with 15,000 rupee average money and they then connect it to that one invoice of 15 lakhs which needs to be factored in, which they know for sure will get collected. Beyond this, they also make sure that they run a credit check on the individual and the company so that they are assured that the person is worthy of the credit. So they do an additional level of credit, which anyway the companies would anyway have done. Third, they also ensure that these invoices are only raised on very, very reputed big companies. It's not. So they have a validated list of companies to which these supplies can be done. And as a result, there's a certain amount of predictability in this money coming back to the investors. So to that extent, these apps have taken a little bit of a room in space and they are meeting an unmet demand. Now, why are businessmen coming to these apps? Because the regular banker is unable to fulfill the credit need of these small businesses, which is why these apps play a role. Let's say a 14% interest, the app retains about 1 or 2%, and the balance of 12% comes back to the investor. Now at 12%, it's a very, very high rate as compared to what he gets in the bank of 6-7%. So he's also very happy. It's only for a 90-day period, it's not a long-term credit. He can cycle it multiple times in a year. So it's a win-win for everybody, but it's very early days in these apps. So if you're somebody who is willing to take that little risk, take that leap of faith into doing some of these investments, trying out, my suggestion would be start with very, very small amounts. You can even start with 5,000 rupees. Try it out. If it works, scale up that investment over a period of time, but don't do too much. Always keep it into a certain limit. And my advice would be not more than 3-5% of your overall money that you have, which will mean that you're taking risk, but that risk is very, very limited, so to say. Certainly worth a try. There are a bunch of apps. What would I check before I lent money to these apps? First, find out if they are registered with the Reserve Bank of India, RBI. Now, to that extent, you have another level of safety that they won't run away into the midnight darkness and you will lose all your money. Second, make sure that all the terms and conditions, the fine print, are read by you before you start your journey, and understand the risk. Now, what is the risk? The company that is supplying the material to the big manufacturer may have a dispute with that manufacturer, because of which the money will not come back. This is a big risk. But as long as your amount is very limited and you're mentally prepared to take that risk, go forth and try it out. I wouldn't try out something like this if the rate of return that I am going to get at the end of the period is less than 12%. It's not worth the risk, but I leave that option to you. I am neither recommending this option, nor am I telling you to go for it. I'd say it's for each one to take that call.